Everyone. Thank you for joining this evening Corporate Connect featuring UOB Group, as well as our audience from Facebook Live. This webinar is organized by SIAS and supported by XGX. We'll kick off tonight's webinar with presentation by Mr. Geoff Howie, market strategist from SGX on recent market highlights, followed by the corporate presentation by Mr. Lu Kao Wing, Vice President, Investor Relations, and we will end off with a Q&A session. I believe we need a little intro about UOB Group, a leading bank in Asia with a global network of more than 500 branches and offices in 19 countries and territories in Asia Pacific, Europe, and North America. Without further ado, can I invite Mr. Geoff Howie to present, please?
Thanks so much, Eileen. I think my screens are all up, and just a very quick 15-minute introduction, which of course is going to be all educational, as we always point out before we rush into the material. So very quick 15 minutes. I just wanted to provide this quick overview of the STI because UOB is such an important cornerstone of our benchmark here. The STI is really the most globally recognized benchmark index and market barometer as well for Singapore. The 30 constituents, as we've said before, they have foundations that span as many as 3 centuries, multiple sectors, while maintaining this really nice balance between local and regional economic exposures. The 30 constituents, they make up something like 60% of our $900 billion of combined full market cap of all the stocks listed on the exchange. And very much like our trade-centered economy, close to half of the revenue that is associated with the STI in its weighted form is actually generated in countries outside of Singapore, mostly within Asia Pacific. And the STI, it's now gained around 9.5% for the first 12 weeks of this year, with dividends further boosting that return to 9.8%, making the index actually the strongest benchmark across Asia Pacific for the year to date. So the past 5 years into the last week of March have seen the index generate a total annualized total return of 5.5%, with the FTSE ASEAN All Share Index generating a 3.6% annualized total return over the same 5 years. So of the 3 overarching market drivers in early 2022, inflation concerns have been one of them, one of the main ones, which has seen an earlier than previously expected withdrawal of accommodative monetary policies across the globe, as we've discussed before. And these inflation concerns of early 2022 have seen very divergent sector returns, very much like the sequentially uneven economic global recoveries we saw in 2021 and before that in 2020. The effect of the higher inflation has seen the bank sector among the strongest global stocks in the first quarter of this year, with REITs among the least performing global sectors for the first half of the quarter. But the one of the third theme, so there's as we said, the 3 themes: the first, inflation; the second, the Ukraine crisis; and the third, quite clearly, the reopening theme. We've seen this more reopening momentum globally place the sector more in the middle of the global sector tally board for the first quarter of 2022. That's the REIT sector. So 10-year US Treasury yields, there's now just sub 2.5%. And for reference, prior to COVID-19, the average daily 10-year US Treasury yield back in 2019 for that year was something like 2.15%, while global REITs actually rallied 20% that year. So a few points just to note on the S-REIT market is that on average, close to 75% of the S-REITs current debts are entirely directly in fixed rates or hedged through floating to fixed interest rate swaps. And in 2021, close to half of the S-REITs listed on SGX announced asset acquisitions valued at more than $12 billion in total purchase consideration. Reopening has also been a key driver of the retail and the hospitality segments of the REITs, while commercial REITs we've seen continue to pivot to tenants in industries that are earmarked for growth like tech, like health. And at the same time, the industrial REITs have been able to contend with resilient manufacturing and trade. So if you look at over the last 3 years through to mid-March, APAC listed industrial REITs averaged something like 40% total returns, while the non-industrial REITs averaged 5% total returns. So I should say, also supporting this reopening theme, this reopening theme, China COVID-19 cases obviously remain elevated, but global cases of COVID-19 have been retracing in recent weeks amid this fifth wave that the world is going through. So the 7-day rolling average of global COVID cases has actually declined from 1.81 million cases on the 18th of March to 1.46 million cases as of yesterday. So that's basically not just seeing the, as we said, the hospitality stocks and the retailer food services stocks move in the local market with the significant initiatives announced on Thursday, but we've also seen this impact across the world as well. But nonetheless, as we said, the higher interest rates have had an impact on the bank sector being one of the strongest performers, while the Ukraine crisis has exacerbated the inflationary pressures that have come with higher energy prices and helped elevate energy stocks even further, so that it's really energy stocks that have been leading the world, with banks at a very close second. Just a quick slide here, just to cover all the STI stocks. I mean, it is pretty dynamic in that if you think about it, since 2014, so for the past 8 years, the STI has seen as many as 5 new companies join it, and as many as 7 real estate investment trusts added to the STI as well. Yangzijiang Shipbuilding was the strongest STI constituent last year, 45% total return on resilient global trade, as the Jiangsu Jiangsu-based shipbuilder booked record orders, and a large part of those orders were also container ships. Sembcorp Industries has been one of the STI's strongest constituents for much of this quarter, and has been the STI's strongest stock so far this year. On Feb 23rd, the company reported, remember, its conventional energy segment had performed exceptionally well in the fourth quarter, while the underlying performance continued to be subject to, obviously, the global energy market conditions and, of course, commodity prices. And it has also pressed on with its strategic transformation of its portfolio from brown to green energy, which aims to be at 70%. So, sustainable solutions portfolio is aiming to comprise 70% of the company's net profit by 2025, which would be up from around 40% in 2020. So the STI, where it is right now, it's around 1% lower than the 34.66 17th of Feb high, but it's up 9.5% already from the 3128 low back on the 8th of March. With those moves, we've seen the 30-day historical volatility of the STI remain pretty much above an annualized 16% for most of March. And that's effectively double the 8% lows that we observed in late January. However, there have been a handful of stocks that within the STI have also showed comparatively lower beta or lower volatility amidst that higher volatility we saw in mid-Feb through to early March. So between 17th of Feb and 8th of March, Singapore Technologies Engineering, Sembcorp Industries, Jardine Cycle and Carriage, Mapletree Industrial Trust, and Keppel DC REIT actually averaged 2.3% gains. They were the most defensive STI stocks, as the STI declined 8.5% from the 17th of March through to the 8th of, from the 17th of Feb through to the 8th of March. And those 5 stocks, since the 8th of March, have also extended those gains, averaging 4.4% gain since the 8th of March, while the STI has added 8.6%. So we have geographical diversity, we have sector diversity, and we also have a lot of diversity in the style of stocks and how they have different volatility profiles in these various market conditions. We also have 2 ETFs that track the STI. They invest in the 30 constituents that make up the STI. So it's the Spider STI ETF and the Nikko AM STI ETF. The Spider STI ETF was unveiled in 2002. It's managed by State Street Global Advisors, while the Nikko AM STI ETF was launched, 7 years later in 2009, and it's managed by DBS's subsidiary, Nikko Asset Management. So the combined asset under management of the two STI tracking ETFs is around 2.2 billion Sing dollars, and that grew significantly back in 2020. So the combined AUM of the Singapore ETFs, it took 17 years for it to reach 1 billion Sing dollars assets under management in 2019. But then it only took another 17 months after those 17 years to reach $2 billion of AUM. So as we said, the banks are a very big part of the STI. So the trio of DBS, OCBC, and UOB make up something like 20% of the total market capitalization of all stocks listed on SGX, in addition to the 20% of the day-to-day turnover of all the stocks listed on the exchange, which total turnover these days is averaging 1.4 billion Sing dollars. And the three banks make up 45% of the STI. So this is why the STI has been the strongest performer so far in the year to date. So banks also generally maintain positive correlations in their net interest income to US interest rates. So Singapore's largest stock by market value, it's DBS, and the correlation or the impact of US interest rates was reiterated by DBS's management a few weeks ago when it reported its full year results. Its management noted that DBS maintains a net interest income sensitivity of 18 million Sing to 20 million Sing dollars per basis point of US rates, and it implies 25 basis point rise in US interest rates equates to 450 million to 500 million of additional net interest income. So of the trio, DBS's net interest margins was most sensitive amid those US interest rate cuts in 2020. So for the fourth quarter of 2019 right through to the fourth quarter of 2021, DBS's net interest margin declined more than 40 basis points. I think it was from 1.86% to 1.43%. And that was, as we said, amid those extraordinary low interest rates. But that I guess, and possibly at the same time, that sensitivity has also been enhanced because the proportion of current and saving accounts, or CASA, within its total customer deposits has also grown from around 59% at the end of 2019 to around 76% at the end of last year. So the combined net interest income of DBS, OCBC, and UOB amounted to 5.31 billion Sing dollars in the fourth quarter of last year. That was up 3% quarter on quarter and up 5% year on year. And it also remained above 5 billion Sing dollars every quarter throughout 2020 and 2021 amid those lower interest rates, after peaking at, I think it was 5.75 billion in the third quarter of 2019. That's the combined net interest income. So there's plenty of other growth drivers. Obviously, loan growth is also important to net interest income, as is net interest margins. But other key growth drivers for the trio, they include a host of key areas. Digitalization, which is not just critical for Singapore, but it's critical for the ASEAN region. The broadening of wealth management services is also very important. A continued focus on supply chains, growth markets, and of course, the ability to keep allowances low are key drivers for the banks. And that emphasis on wealth management and so forth, it was exemplified as well with UOB proposing to acquire Citi's consumer business in Indonesia, Malaysia, Thailand, and Vietnam back on the 14th of January. And I think DBS announced just 2 weeks after it was acquiring Citi's consumer business in Taiwan. So that's setting the stage here for UOB. I'll finish in a couple more minutes. I've got 2 more minutes just to add that year to date, the trio of DBS, OCBC, and UOB have gained 12% in the year to date. The outlook for the higher interest rates has offsetted some of the, I guess, the broader economic uncertainty of decelerating global growth rates, geopolitical uncertainty, and so forth. From the end of 2021 right through to the 15th of March, expectations that the Fed Reserve would move the Fed fund rate target band from 0 to 25 basis points, right up to 200 to 225 basis points. That's 8 times 25 basis point hikes, total of 8 times 25. Those odds increased from 0% at the end of last year to 34% to 15th of March, which was the eve of the FOMC, most recent FOMC. They jumped to 59% immediately following the 16th of March FOMC, and those odds have increased up to 92% by the time of the Asia close last week, according to the CME Fed funds rate. So the focus on interest rates is a week-to-week, night-to-night proposition. Banks are recognized globally as a stock sector very impacted by rising interest rates, and hence this sector is expected to remain squarely in the frame, not just throughout the FOMC calendar, but also the speaking schedule of Fed participants. And generally you have, if you're not in a Fed blackout period, which is a fortnight before the Fed actually has its FOMC, you generally have 5 Fed speakers at least speaking every week. And then, of course, you've got the high frequency data prints that are providing all the global inflation and the growth cues as well to follow. So a very dynamic sector at the moment, very much in the frame and focus of not just investors, but also short-term traders. And I guess on the valuation front, as of last week, the average price to book ratio of the trio was around 1.28 times, which represented a 4% premium to the median of the top quintile and the top quartile of global banks by market value. And that's after the average PB price book ratio of the trio pretty much ended in line with the top quintile and top quartile of the global peers at the end of last year. And just on a final note as well, before Ka Wing speaks, I'll just also add that DBS, OCBC, and UOB, they currently rank as the 2nd, 6th, and 7th largest stocks of the FTSE developed APAC ex-Japan Sustainable Yield Index. And that tilts towards stocks not with extremely high yields, but rather the financial and operating strength of the stocks is where the index tilts to, with specific emphasis on companies with strong balance sheets and the ability to generate cash flow. So that will conclude my quick 15-minute session, and I'll go and start watching the remaining of the session from Facebook. Thank you so much, Eileen.
Thank you, Geoff, for the market updates. Up next, may I invite Mr. Lu Ka-wing, Vice President of Investor Relations of UOB Group. Over to you, Ka-wing.
Hello, hi everyone. Just let me get my screen ready. Hi, good evening, and thanks for joining the webinar. My name is Ka-wing, and I'm from the Investor Relations team at UOB. We'll be running through this presentation deck this evening, which you can actually download from the SGX Corporate Announcements website. Yeah. So on the agenda tonight, we will first go through an overview of the UOB Group before diving into the unique strategy that sets us apart and powers our growth. And finally, I would like to take a look at the numbers before we wrap up with the summary and end with Q&A. Yeah. So we'll start off with an overview of the UOB Group. This slide has quite a lot of information on it, but it provides a quick snapshot of our group, its history, and some financial numbers that is of interest to both equity and fixed income investors. I won't ask you to focus on too much of the message, but the key point to take away is that UOB is a leading Singaporean bank that was founded 87 years ago in 1935 by Datuk Wee King Chiang. And this means that the bank has actually been around before World War II and has a history that dates back before the Republic of Singapore was officially founded. Now, throughout all these years, the founder's family has always been involved in the bank. To this day, it remains an owner-operated bank. Datuk Wee's grandson, Mr. Wee Ee Cheong, is the CEO today, and his family remains the largest shareholder with roughly an 18% stake in the bank. Now, having run the bank for the last 87 years, the family obviously takes a long-term view on the business. This means that long-term shareholders do not need to worry about corporate governance issues where management interests are not aligned with shareholder interests. In this case, the management is actually the largest long-term shareholder. So I think this is one of the things that makes UOB different from the other Singapore banks. None of them are owner-operated. Also, as you shall see later, UOB has the most comprehensive regional Southeast Asian platform compared to the other Singaporean banks. Now, this slide shows the main divisions of the bank. UOB is obviously a familiar name in Singapore. Not only are we a household name in the retail banking space, where we are sizable players in mortgages, credit cards, and deposit accounts, we're actually also one of the leading SME banks in the country. This is what we are known for. And as you can see, we have won numerous awards for the best retail bank and SME bank in the country. But besides retail and SME banking, what many people may not know is that we have been growing our corporate and institutional business. And as you will see in later slides, this division has been growing very well and is now a big portion of the business and bank today. Now, to wrap up, if you look at the bottom right, what I wanted to highlight here is that Singapore is our home and our base. More than half of our profits come from Singapore. And in terms of domestic market share, we control about 20 to 24% of Sing dollar loans and deposits. Moving on to the next slide. This shows our earnings trajectory over the past 57 years. If you look back in 1980, our net profit was only $92 million. This has grown 44 times to 4 billion Sing dollars as of 2021. And all this was achieved as our franchise across the region expanded, growing both organically and through a series of strategic acquisitions over the years. You can see that in terms of inorganic growth in the past, it happened in two distinct phases. The first phase was in the 70s and 80s, while the second phase happened right after the 1998 Asian financial crisis in the early 2000s. And if you look at the timeline, the last time we did an acquisition was actually 16 years ago. That doesn't mean that we're stopping. Looking ahead, we are looking to expand our franchise even further. If you have kept in touch with the news, we actually recently announced the proposed acquisition of Citigroup's retail businesses in Thailand, Malaysia, Indonesia, and Vietnam. Now, just to recap the key message when we made the announcement about this deal with Citigroup is a game changer for us in the region. It will deepen our presence in Southeast Asia with the right strategic customer segments and bring on board a complementary staff force and product suite. Once completed, the deal will double our retail customer base to 5.3 million customers in the respective markets, helping us to scale up 5 years ahead of schedule. So in short, if you believe in the growth potential of the region, you can continue to expect this upward trend in earnings to continue into the long term as we dig down deep with our franchise. The other point to note here is that this profit growth that you see over the last 60 years or so, it actually happened through many volatile periods, including the 1998 Asian financial crisis, the global financial crisis in 2008, the 2020 oil price crash, and now the ongoing COVID epidemic. So throughout all these ups and downs, we have continued to deliver earnings growth to our shareholders. And this slide, what I wanted to show here is our footprint in the region. You can see that on the right. Singapore may be our home base, but the franchise spans the Southeast Asian region all the way into the Greater China region in North Asia. We are proud to say that we have the most comprehensive network in the Southeast Asian region. And why is this important? Because it allows us to tap into the potential of the region. And you can see that potential summarized in the charts on the left here. The region is close to China and major markets. It has a combined population of more than 650 million people, with more than half of its population being less than 35 years old. It is the third largest population base in the world after China and India. And almost all the economies in this region are open economies linked to international trade and the global supply chain. So this has led to decades of improving income levels, as you can see from the GDP chart, and much of that is driven by increasing trade and FDI into the region. So our platform allows us to tap into these cross-border flows. Because of our platform, we are better positioned than other banks to help customers do business across the region. We can help to bring Singaporean companies into China and vice versa, or Thai companies to Singapore to raise funding. This is one of our key differentiating factors. So with that, we'll move on to the next part of my presentation, where I talk about our strategic priorities. And this slide summarizes the strategic priorities that UOB has. How we see ourselves adding value to customers and society. And at the crux of it lies our DNA as a financial intermediary with the most comprehensive network in the Southeast Asian region. Because of our platform, our wholesale banking division is able to help our corporate and business customers facilitate cross-border transactions when it comes to trade or investments. Also, as one of the leading foreign banks in the region with strong local currency franchises in our chosen markets, we are able to capture the right customer segments in the consumer banking space. Over the years, from simple delivery through bank branch channels, we have evolved to embrace an omni-channel approach towards customer engagement. This keeps us connected with our retail customers, enabling us to help them along with their financial and wealth journey. Now, our last strategic priority is how to forge a sustainable future. Because we are so entrenched into societies and economies in the region, we are also acutely aware of how customers and businesses are evolving as societies adopt more sustainable lifestyles. We see this evolution as a huge opportunity and have been at the forefront of this space by embracing sustainable concepts ourselves while helping investors and customers along the same path with sustainable financial solutions. The next few slides touches on each of these topics in greater detail and highlights some of the progress that UOB has made so far. Now, this slide talks about the wholesale banking division. This division contributed to more than 60% of earnings in 2021. And for this division, we have been focusing on enhancing our capabilities and diversifying across geographies, sectors, and products. These efforts have resulted in extremely strong growth in this division. In fact, in 2021, when our loan book grew 29 billion Singaporean dollars, almost all the growth came from this division. Today, cross-border income accounts for $1.3 billion, or 30% of group wholesale banking's income. We expect this figure to grow as the COVID epidemic has accelerated the pace of supply chain diversification into Southeast Asia, and the reopening of borders and markets will also help boost trade and the financing opportunities that come with it. We think UOB is well positioned to ride on these trends because of our comprehensive regional network and deep local knowledge in the region. Our sector-specific insights and solutions also help to synergize businesses and to mitigate risks across their value chains. Another area where we have been able to carve out a niche is with the global funds, banks, and non-bank financial institutions in the region. Our financial institutions group has been very successful in capturing the flows to this region from this segment. Income from the global financial institutions group grew 21% in 2021, as you can see, in the middle point on the slide. So we are definitely making a lot of progress in the wholesale banking side. To solidify our momentum, we continue to invest in and develop our digital platform. This helps improve convenience and security for our corporate customers. And as you can see here, digital banking transactions have increased 25% year on year in 2021, while the number of cashless payments to SMEs and corporates through Corporate Pay Now in Singapore is up 3 times in 2021. So we have achieved a lot of progress in the wholesale side. Moving on to talk about the retail and consumer banking division. This is our bread and butter, and it makes up about 38% of earnings in 2021. At the risk of pointing out the obvious, gone are the days when retail banking involved just providing staple banking products like mortgages and deposits to customers through bank branches. Times have changed as customers' financial needs and technology evolve. As a person's income grows along with his career and life cycle, his financial needs will clearly evolve as he amasses more wealth and approaches retirement. Our philosophy is to keep engaged with the customer, standing by their side in life and helping them achieve their financial goals through an omni-channel approach. What do I mean by that? In essence, we want to be engaged with the customer almost on a daily basis. And how do we do that? We make ourselves accessible to them through our digital banking app, UOB Tomorrow, which gives them a platform to make payments, funds transfers, invest, and plan their financial journey. We open our doors to them through our branch network. As financial needs evolve, we also have relationship managers catering to affluent customers who require more complex financial solutions. In short, we provide multiple avenues and touch points to stay engaged to help customers along their financial journey. This is something the digital banks are unable to do. We provide access to the most comprehensive branch network across Southeast Asia, which other banks are also unable to do. This is how we have differentiated ourselves in the retail banking space. Now, complementing our omni-channel approach is our ecosystem partnerships. We've partnered up with Fave in Singapore and Bhinneka in Indonesia as an example. Customers we engage through this omni-channel approach generate at least 50% more revenue than physical-only or digital-only customers. This unique platform that we have is not something that we built overnight. We started our digital transformation journey since 2016. Investing in digital capabilities and transforming our physical touch points. Today, we are seeing the fruits of these investments. And just to highlight some numbers, assets under management rose 4% year on year to a new high of 139 billion Sing dollars. And of these, 60% was from overseas customers. Now, before I move on, I want to point out a critical pillar of our omni-channel platform. This is our digital bank, UOB Tomorrow. This channel allows us to acquire new customers at scale and to serve them in a more cost-efficient manner. Since 2018, 800,000 customers were digitally acquired by UOB Tomorrow. In 2021 alone, 350,000 customers were digitally acquired, 70% of which are new to bank customers. With this channel, we are more than prepared to face any new digital bank entrants. We have the capability to do whatever they can do, but they may not have the ability to do what we can do. So that summarizes our consumer banking story. And moving on to sustainability. Here, we highlight our sustainability efforts and the progress we have made. This is a key pillar in our strategy. Now, in line with the UN 2030 Agenda for Sustainable Development and the Singapore Green Plan 2030, we are committed to play our role in the region's transition towards a sustainable and climate-resilient economy. In 2021, we have achieved operational carbon neutrality, meaning that our direct operations are now carbon neutral. So we do not just talk about sustainability, but we actually walk the talk. In our opinion, there are lots of opportunities for UOB as societies embrace greener and more sustainable lifestyles. According to a study by consulting company Bain & Company, There is $1 trillion in green and sustainable opportunities for Southeast Asia. To capture these opportunities and facilitate the evolution to a greener future, UOB has developed the UOB Sustainable City Solutions, which is a comprehensive suite of customized financial solutions. As at the end of 2021, our sustainable financing portfolio totaled more than 17 billion Singaporean dollars. In 2021 alone, this portfolio grew by 5.5 billion Sing dollars, 50% higher than the previous year. We are also seeing a growth in interest in responsible investments. Total assets under management in ESG-focused investments have now hit an all-time high of 9 billion Singaporean dollars, 4 times more than a year ago. Now, to give an example of the tangible environmental impact we have made, our U-Solar program, which is Asia's first solar industry ecosystem, has facilitated the generation of 274 gigawatt hours of solar power across ASEAN, reducing more than 142,000 tons of greenhouse gas emissions, which is equivalent to 2.3 million new trees planted or the removal of 31,000 cars off the road. Now with that, I'll jump on to the next part to talk about our numbers. This slide is a very simple slide. The message is self-explanatory. The chart on the left shows our loan base and how it has grown over the years since 1998. Now, in the span of a little more than 20 years, our loan base has increased by more than 10 times. But lending money is easy. Yeah? Anyone can grow loans because there is always loan demand. The question is whether you are able to collect back what you lend out, a problem that loan sharks struggle with. Now, on this point, we are very proud of our achievements. We have never compromised asset quality in our quest to grow. If you take a look at the chart on the right, we were badly hit by NPLs in the 1998 Asian financial crisis. Now, there was no way we could have avoided the pains from this period as we were at the heart of the economic upheaval in the region. But what we did was we learned from our mistakes. We picked the right customers and we stand by them through thick and thin, helping them through the various macroeconomic cycles. As a result of our careful credit policies, you can see our NPL ratio in the chart on the right. It has improved significantly from the post-Asian crisis years and have been maintained at a very low but stable level of between 1 to 2%, despite the various macroeconomic crises that we have been through since 2007. So we are good at lending money and we are also good at collecting it back. Now, this chart gives you a flavor of how our loan book is carved up. It shows you where the money has gone. In terms of geography, half our loans come from Singapore, with the remainder spread out across the Asian region. Our key markets here are Malaysia, Thailand, Greater China, and Indonesia. And in terms of economic segments, you can see in the pie chart on the top, the loan book is actually very diversified and most of it is secured. And lastly, in terms of customer segments, if you look at the chart on the right, corporate loans make up more than half of our book, while consumer loans account for about a third of our loans. So that gives you an idea of our loan portfolio. But as a commercial bank, we need to fund our lending business. And that is mainly funded with customer deposits. The deposit-taking business is the lifeblood of the bank and provides the raw material to undertake all our businesses. Now, this is arguably the hardest part of banking. Yeah? Lending money is easy, but asking people to put their money with you is much more difficult. Not only does it require regulatory licenses, it requires trust from depositors that their money is safe with you. This trust has been built over almost 9 decades. As you will see in the chart on the left, we have actually grown our deposit base significantly. Again, almost 10 times, almost 20 years. And if you look at the chart on the right, the pie chart, more than 50%, almost 60% of our deposits are actually coming from sticky current accounts and savings accounts, with the remainder being funded by fixed deposits. So what does this all mean? All this loan growth, deposit growth, and balance sheet growth. These two charts say it all. On the left, you can see our total income or revenues, while on the right is our net profit after tax. What is obvious is the trend in both revenues and profit. We are generally making more money over time, even during difficult economic periods like the 1998 Asian financial crisis, the 2008 global financial crisis, or the recent COVID epidemic. You can see that we are still making money. Sure, the growth in earnings may fluctuate for 1 or 2 years, but we always weather through these periods, emerging stronger. And as our earnings grow, to reward our long-term shareholders, we currently have a policy of paying out about 50% of our core profits as dividends. This has resulted in a total dividend per share of $1.20 in 2021, amounting to total dividends of 2 billion Sing dollars. As long as we maintain our profit growth trajectory, shareholders who stick with us can look forward to higher dividends over time. One point to note in this slide is the dip in dividend per share in 2020, but this happened mainly because the Monetary Authority of Singapore capped dividends from banks at 60% of 2019 levels. So, in summary, what do you get when you invest in UOB? You get a Singaporean bank that is intimately tied to the growth and rising affluence of Southeast Asia. You get an owner-operated bank where the interests of long-term shareholders are aligned with management. You get a bank that has weathered through numerous ups and downs, including wars, epidemics, and economic cycles over the past 87 years. And a bank that consistently delivers on growth, earnings, and dividends throughout its history. Now, with that, I will wrap up for questions and answers, if there are any.
Thank you, Kawing, for the broad overview and UOB business strategy, especially on its sustainability effort. We now come to the Q&A session. May I invite Mr. Benjamin Goh, Head of Research and Investor Education from SIAS, to moderate the Q&A. Over to you, guys.
Thank you very much, Eileen. And also, thank you very much, Kawing, for the very illuminating presentation. I guess for people who are a little bit more concerned with what's happening in Ukraine, there are a couple of questions, and I think we can start with those, given that the last few slides you're talking about was related to your loan exposure, UOB's loan exposure. Okay, so let's dive in. And these are the questions that's been collected from members of the public through various channels in SIAS. All right, so the first question is about the Russia-Ukraine crisis. The question is, what is UOB's exposure to Russian and Ukrainian related loans?
Thanks for the question, Benjamin. Now, at the heart, our DNA is a Singaporean bank, right? That's our home market, but we are mainly and we have a branch network that spans across Southeast Asia all the way to Greater China. That is our focus. That is where we operate. That's our playground. So our exposure, direct exposure to Russia and Ukraine is insignificant. We have actually zero exposure there. So I wouldn't be too worried about the direct impact.
All right. Okay. And okay, the next question here is, what about not just direct exposure, but also possibly Russian entities that have been sanctioned?
We have no exposure to Russian entities that are sanctioned.
Okay.
But we are constantly in conversation with regulators to keep in touch and up to date on what's happening with all the sanctions. And we will definitely work closely with them, but we have no exposure.
Okay. I guess it's a matter of concern for some members of the public, given the severity of these sanctions and the what's been happening over there.
Yeah, I can understand that.
Yeah. Okay, let's move on to some of the business-related questions. So how much of Citigroup's Southeast Asian business can UOB retain after taking over? And how does UOB envision it strengthening its SME banking?
Okay, I'll break that questions into two parts. So the Citi acquisition is not complete, just to be clear. Yeah, we are basically going through the process, awaiting regulatory approval. The reason why we actually thought this Citi deal was a very good deal is because it was strategically a very good fit. Yeah. As I mentioned in one of my slides earlier, it has been 16 years since we last did an acquisition. So we don't simply, make an acquisition for the sake of it. We really feel that there's a lot of value in this. It was a complementary fit in terms of customers, in terms of products, and in terms of people. Strategically, it made sense for us because one of the biggest challenges that we had for the retail business in the region, ex-Singapore, is scale. With this acquisition, it kind of like doubles our customer base to about 5 million retail customers. So in one move, it basically helps us to scale up significantly. It enables us to get to where we want to go to overnight. Now, the risk is of attrition, as you highlighted earlier. How much of the business can we keep? We have factored in our numbers a revenue attrition of about 10%. But based on what we have seen so far, we have seen very good progress so far with Citi. The numbers are probably going to be much better than what we expect. But as I mentioned, we're awaiting regulatory approval across all the 4 markets.
Okay.
The second question you have is with regards to how we plan to grow our SME business. Am I right?
Yeah.
So generally, banks compete in 4 ways: pricing, product, platform, and people. For UOB, specifically in the SME banking space, the focus is actually a lot on people. And what I mean by that is relationship. If you recall, I mentioned earlier that what we do is we pick our customers and we stand by them through thick and thin. For SME customers, I think that is extremely important because those SMEs that have been through the cycles, I think some of them have experienced some negative experiences with other banks where they pull the credit lines away from them when times are bad. So UOB, we don't do that. We stand by our customers. And I think that's the key reason why our customers are sticky and why we do so well with SME customers. Now, that doesn't mean that, we just focus on relationship alone. We have basically been investing a lot to improve our product suite, to improve our trade finance products, our cash management, and basically to help our customers evolve as they grow, right? So we have to keep growing with them too. We've also invested a lot to improve our platform, right? To roll out a better digital platform called Infinity. So those are the 3 main ways that we plan to grow our SME business.
Okay, thank you very much for that. And I guess all the best for the acquisition of the Citigroup. It sounds like the lower attrition possibly could be because there is a difference in the clientele type, so it's not too much an overlap.
The clientele from Citi is very complementary to ours. So maybe just to give you a flavor, outside of Singapore, we are not a big market leader in the regional markets. In Singapore, we have 20% market share, as I highlighted earlier. But we are fairly small in the regional markets when it comes to the retail space. So what we do is being small, we have the liberty of being able to pick and choose who we want to bank with. We don't just bank with any person that walks in, right? So what we do is we actually want to be in the mass affluent space and above. Citigroup's customers give us that, right? It is a very complementary customer profile. It fits very well with the target segment that we want. So that's one of the reasons why the Citigroup acquisition makes so much sense to us.
Okay, good. The next question here, right, something about high interest rates. I guess this is also in the financial news nowadays. So how would UOB position itself for the coming interest rate hike, as well as the higher inflation numbers? I suppose the headline inflation in the US is 7.9%, and in Singapore is about what, 4-5%. So that's relatively high based on historical norms. So how does UOB intend to position itself for those two twin items coming in?
Let me give you a numerical answer first. We've done the math, we've crunched the numbers. Generally, a 25 basis points hike in the US Fed funds rate should lead to a 4 to 5 basis points improvement in our net interest margin. In dollar terms, that works out to be about 150 to 200 million Sing dollars per annum uplift. Yeah.
And I'm just quickly calculating the expected Fed funds rate will end at 2% at the end of this year. So that's what, 150. What do you mention? 150 times 8 then, right? 8 tranches of 25 basis point increases.
So far, I think we have refrained from giving an exact stab.
You know, you talk tomorrow. I'm
going
to buy you a piece of shares.
Yeah. I mean, that seems to be a moving target. So, you know, we'll leave it to the market pundits to guess how many Fed funds rates there are. Yeah. So on your point with regards to inflation, I think much of that depends on how much of that inflation can be passed on to the consumer and how much can be absorbed. And also more importantly, whether that inflation is accompanied by economic growth. Generally, if there's growth, even if there's inflation, I think things will be great, will be fine. Banks suffer when there's deflation. Banks suffer when there's hyperinflation. Banks also suffer when there's stagflation. As long as there's growth, I think we can deal with inflation.
Okay. And I guess, you know, the complementary information coming out, MAS, is that they are tightening the Sing dollar FX ban. So at least, you know, you'll try to kind of minimize the impact of the imported inflation coming in. All right, that's good. But I have certainly taken something out of the last 2 minutes from your discussion. Okay. All right. Next question here. Where does UOB see its greatest opportunities to grow with regards to further acquisitions?
I think we are always on the lookout for if we see a right strategic fit. I think we will be open to exploring. But as of now, we really have our hands full. So right now, you know, we'll probably just dig deep into what we have with Citi first.
Okay, that makes sense. So want to make the completion of the acquisition a great success before considering other acquisitions. Okay. Okay. So there is a question about the recent string of investment scams. So the question here is, what are the proactive precautions that UOB is doing to prevent similar incidences from happening in the future?
Yeah, that was well. We have actually implemented all the 7 consumer protection measures that have been announced by the Monetary Authority of Singapore. But I think beyond that, we've actually invested a lot in a monitoring system that detects, blocks, and alerts us to potential suspicious transactions. And we've also doubled down on our efforts to, you know, educate employees and customers on scams and how to identify signs. Of course, we will collaborate with regulators, and also we've been talking a lot to industry peers, just to make sure that we are in the loop of what's happening and to share information to mitigate the risks of such scams in the future.
Okay, and I would also want to kind of further add to what you have mentioned just now, simply for members of the public, that it's not just the bank or your counterparty that is 100% responsible for making sure that your transactions are secure, because a lot of these scams happen because we give in to social engineering. It's like you are befriended by somebody on your Facebook, and I don't know, the last few weeks I've been getting a lot of LinkedIn connection requests, and the picture is always some really good looking Chinese girl. I don't know, but the message, is not, it's really not, doesn't not in sync with the photo. So things like that, right? Simple things, you don't just go and friend somebody simply because, she's good looking or he's good looking, things like that. And of course, you should never ever give away your personal details, right? So just want to point that out, because we have also been working with Singapore police, all these scams, especially for cryptocurrencies, always a big issue, right? Okay, so let's move on to some of the questions that have been just submitted in the last few minutes here. Okay, so a question again on the exposure, UOB's exposure. First one to oil and gas, and the second one to Europe in general, not just Russia or the Russian sanctioned entities. So any insights as to the exposure for UOB in those sectors?
Oil and gas, and which other sector did you mention?
Europe in general.
So the exposure to Europe in general is generally quite low. I mean, we have some interbank exposures, but again, based on my the presentation earlier, we're basically mainly focused on Southeast Asian and the Asian region. So I don't think there's anything too much to worry about. With regards to commodities exposure, I think our total commodities exposure is less than 5% of our loan book. Yeah.
Okay.
I think again, it's not exactly a very big portion that that will be of cause of concern.
Okay. All right. Okay. Let's move on to a different question. So blockchain. So how do you think blockchain technology and cryptocurrency may impact the traditional banking business in the long term? This one is an interesting one.
I think in terms of cryptocurrency, it basically sidesteps the traditional channels of payment, right? Linking the payer to the payee directly. So if it is adopted generally, it will be a threat. But I find that very difficult to see that happening. I can't imagine any central bank in the world giving up its monetary its power over the monetary policy, right? So I think the risk of cryptocurrency on the banking sector in those terms is very low. In terms of blockchain technology, I think there may be some opportunities there, but we are basically exploring it, and the technology is evolving. Yeah.
Okay, I mean that certainly fits in with I guess announcements by MES. There was that Project Orchid, so they're experimenting with the digital central bank currency, so on and so forth. I guess even for that kind of mode of settlement, intermediaries such as UOB will still need to be fully involved in the ecosystem, right? Yeah, so also agree that unless I'm going to go to my wet market and then pay in bitcoins, I don't think I can do without a bank. All right, yeah, it'd be pretty strange. Okay, I think we only have time for one more question. Let's pick this one here. The non-performing loan numbers looks fantastic. Could you please just confirm that the percentage of overall value of loans advanced? I think you had a PowerPoint slide on the left-hand side. There was what, $300-ish billion there was advanced in the latest column, was it?
Yes, it's actually 307 billion Sing dollars.
Okay, and on the back of that, the NPL percentage was about 1.6.
1.6. Yes.
1.6. Okay, so I think this viewer just wanted to kind of get that right. Okay, all right. So thank you very much, Howie. Certainly a privilege to have you here answer all our questions. And you know, UOB is obviously one of the pillars in the STI index. You know, generally I buy the STI ETF. I mean, my own personal investing, simply because I'm just too lazy to go through all the financial reports. But you know, on a personal basis, I think this this tonight's Corporate Connect session has been a very we don't want to use the word profitable, illuminating, because obviously SIAS really can't make recommendations. All right, so but thank you very much for that. All right.
Thank you,
Okay.
Benjamin.
All right, Eileen, over to you.
Thank you, panelists, for an insightful sharing tonight. Unfortunately, we cannot answer all the questions, but if you have any questions, do reach out to the UOB Group Investor Relations or SIAS for any further questions that you may have. So we have come to the end of the session. Thank you, everyone, for joining this evening. So in case if you miss any part of today's session, you can rewatch the webinar on SIAS YouTube channel. So Corporate Connect is a bi-monthly webinar. Do visit our website to get updates on our upcoming investor education programs and initiatives. The upcoming Corporate Connect will be featuring IHH Healthcare on the 12th of April. Thank you very much and have a good evening.